Have you ever heard the term hedge fund and felt, I don't know, a mix of curiosity and maybe a little confusion? They pop up in headlines, often seem kind of mysterious. But what exactly are these investment vehicles and how do they really make money?
It's a pretty common reaction, actually. The industry does have this reputation for being complex, maybe even opaque. But, the underlying strategies are often surprisingly logical, sometimes quite clever once you sort of peel back the layers.
Exactly. And that's what we're trying to do today. We're taking a deep dive into the world of hedge fund strategies. Our mission, really, is to cut through some of that jargon, understand the different approaches these funds take, maybe unravel how they actually manage risk, and ultimately reveal their sometimes surprising impact on a broader investment portfolio.
Yeah, and we've got some great source material here, really comprehensive stuff covering everything from how they're classified to the nitty-gritty of implementation, risk analysis, and that portfolio impact you mentioned.
So by the end of this deep dive, you should be equipped with a much clearer understanding of this vast landscape, hopefully moving beyond the headlines to appreciate the real nuances.
Absolutely.
Okay, so let's unpack this. When we talk about hedge funds, it's easy to sort of lump them all together, right?
Yeah.
But our sources show there's a huge world of difference. How do we even begin to categorize them?
Well, what's fascinating here is that the classification often comes down to a mix of things, like what the managers actually invest in, their trading philosophy, and crucially, the types of risks they're willing to take on. At a high level, you basically have two big buckets. You've got your single manager funds run by one team, usually with a very focused strategy. And then you have multi-manager funds.
Okay.
And that multi-manager category itself splits a bit. It includes multi-strategy funds operating under one roof, or what are called funds of hedge funds, or FOFs, which allocate capital out to other separate hedge funds.
Whoa, hold on. So a fund of funds is literally a fund that just invests in other funds. That's layers deep.
Precisely. Yeah, it's turtles all the way down, almost. But beyond that broad split for our discussion today, the sources grouped the individual hedge fund strategies into six, let's say, practical categories. It's really helpful for understanding their different risk profiles.
Okay, 6 categories. What are they?
We've got equity-related, event-driven, relative value, opportunistic, specialist, and then that multi-manager category we just touched on.
Got it.
And using this framework is really your first step to seeing that, not all hedge funds are creating equal. They're definitely not all just making big bets on stocks going up or down. They're often trying to achieve very specific goals in, well, very specific ways.
Okay, this is where it gets really interesting, I think. Let's explore some examples within these categories. What are they actually doing day to day to generate returns?
Absolutely. Let's look at a few that really highlight the diversity. Starting with the equity-related category, two main types here are long-short equity, LS equity, and equity market neutral, EMN.
Okay, long-short equity. I think I've heard of that one.
Yeah, it's probably the most common. With LS equity, managers buy stocks they think are undervalued, and at the same time, they short sell stocks they see as overvalued. The aim is to earn what's called alpha. That's basically returns generated purely by the manager's stock picking skill, above and beyond whatever the overall market is doing. They typically maintain let's say, a modest net long exposure, maybe 40–60% net long, so they still have some tilt towards the market going up.
Okay, so they're still generally leaning long, but the shorts give them a way to potentially make money even if the market dips, or at least reduce their overall market exposure. That makes sense.
Exactly. Now, EMN equity market neutral strategies are much more aggressive in trying to neutralize that market exposure completely. These funds aim for near net zero exposure to the overall market direction.
Net zero. How do they even do that?
Well, think of it like this. Maybe betting on two related companies in the same sector. You might go long one you think is undervalued and short the other you think is overvalued. They take opposite long and short positions in related equities where they see divergent valuations. The idea is that the market direction shouldn't matter, only whether they pick the right stocks relative to each other. And because the individual pricing differences they exploit are often tiny, really small, they tend to use high leverage to achieve meaningful returns. And their portfolios are often highly diversified and quite quantitative. Lots of computer models involved sometimes.
So EMN is essentially trying to completely cancel out the market movements.
Yeah.
And just profit from the difference between specific stocks. That's a fascinating way to try and make money. Almost like a pure test of a manager's stock picking skill, isn't it?
It really is.
And what role do these play in a typical investment portfolio, LS versus EMN?
Right. LS equity is generally designed for lower volatility than traditional long-only stock strategies. The sources suggest maybe around 50% lower standard deviation, while still aiming for similar sorts of returns over the long run. EMN, on the other hand, given its market neutrality, is potentially excellent for non-trending or even declining markets. It's trying to capture that pure alpha without taking on beta risk, which is just jargon for the risk of the overall market moving against you.
Okay.
They can even complement fixed income investments when bond returns are low. But, and this is a big but, that high leverage means there's potential for forced selling or downsizing during periods of market stress if things go wrong.
Right, that leverage cuts both ways. Less about market direction, more about those individual stock plays. Makes sense. Okay, next category up was event-driven, and you mentioned merger arbitrage as a clear example.
That's right. Merger arbitrage managers focus specifically on corporate events. In this case, they're trying to profit from the small price difference, the spread between a target company's stock price after a merger or acquisition is announced and the final price it gets acquired at. Most U.S. mergers, the data suggests something like 70% to 90% actually do successfully close. So it's often seen as a bet on a high probability event happening.
Okay, betting on the deal going through.
Yeah, and our sources describe the payoff profile in a kind of interesting way. They say it resembles a riskless bond plus a short put option.
Okay, that's a bit technical for some of us maybe. Can you break that down a bit? What does that actually mean in practice?
Sure, think of it like this. Most of the time, the deal closes as expected, and you collect that small spread. That's your steady bond-like return, small but consistent.
Right.
But the short put option part represents the risk that the deal unexpectedly fails, maybe regulators block it, or something else goes wrong. If that happens, the target company's stock price can plummet, and you face a sudden, potentially large loss.
Okay. Like selling insurance. You collect premiums, but then there's that rare disaster scenario.
Exactly. That's the left tail risk, a rare but potentially severe downside that can wipe out a lot of those small, steady gains.
And how do they implement this? Is it just buying stock?
Usually the main positions are in common equities, yeah. But they might also use derivatives like options to manage the risk or maybe enhance the returns a bit. And leverage is common here too, usually moderate to high, maybe 3 to 5 times the fund's assets.
And in a portfolio, what's the appeal?
It's generally considered a relatively liquid strategy, and importantly, its returns tend to be pretty uncorrelated with the broader stock and bond markets. It can offer high Sharpe ratios, that's return per unit of risk, and often aims for low double-digit returns.
So you're essentially betting on a deal closing. You get a small but fairly reliable profit if it does.
Yeah.
But if it breaks, yeah, watch out. Got it.
Okay, moving on to the next category, relative value. And here we have fixed income arbitrage, FIA.
Fixed income arbitrage. Sounds like finding small differences in bond prices.
That's exactly it. FIA strategies try to exploit tiny, often fleeting pricing inefficiencies across different debt securities. The goal is usually either mean reversion, betting that prices that have drifted apart will eventually snap back together, or earning positive relative carry.
Carry. What's that?
Positive carry is basically earning a small, consistent income from the difference in yield between two related bonds, maybe one you hold long and another you hold short. Think like borrowing cheaply and lending at a slightly higher rate. And because these pricing differences, these inefficiencies are so incredibly small, these strategies typically use substantial leverage.
How substantial are we talking?
Often 4 to 5 times assets, but sometimes, for certain strategies, it can be much higher, even 12 to 15 times, according to our sources.
Wow, okay. That's serious leverage. They must be hunting for minuscule differences then.
Absolutely minuscule. They'll buy what they see as undervalued debt and short sell related debt they think is overvalued.
Yeah.
And they often try to hedge out or immunize against general interest rate risk, so they're focused just on that relative pricing.
Can you give an example?
Sure. A classic one might be trading different points on the yield curve, betting on whether the gap between short-term and long-term interest rates will widen or narrow. Or another is the carry trade of buying slightly less liquid government bonds, called off the run, and shorting the more liquid current on the run bonds, hoping to capture a small yield difference.
Interesting. And the risk profile here?
Well, while they can be attractive for their low correlation to other markets, their payoff profile, much like merger arbitrage, often resembles that short put option, meaning they can be quite vulnerable during market crises or liquidity crunches when those small spreads can suddenly blow out.
Another one with that hidden tail risk then.
Okay.
Now for the opportunistic strategies. These sound like they're looking for bigger, broader themes maybe. We have global macro and managed futures.
Indeed. Global macro funds are definitely big picture. They focus on broad global relationships across a really diverse range of asset classes. We're talking currencies, commodities, fixed income, equities, you name it. They base their trading decisions on their macroeconomic views, like what they think central banks are going to do or how different economies are performing relative to each other. They aim to be anticipatory, getting ahead of major trends.
And I'm guessing leverage is involved?
Oh, yes. They are typically highly liquid, largely because they trade in deep markets, and they often use high leverage, usually through derivatives like futures and options.
Okay, and managed futures, that sounds different. Systematic, maybe?
It is quite different, yes. Managed futures primarily uses systematic, quantitative approaches. Think computer algorithms looking for patterns. They're often based on pattern recognition or trend following in futures and options contracts across a whole range of markets: commodities, currencies, equity indices, bonds. Like global macro, they're also characterized by high liquidity and high leverage.
So what's the role of these two in a portfolio? They sound powerful, but maybe risky with all that leverage.
They can be incredibly powerful diversifiers. Global macro can be excellent for portfolio diversification and generating alpha, especially sometimes during periods of market stress. Think back to the 2008 global financial crisis. Some macro funds did very well by anticipating the subprime mortgage issues. Managed futures are also extremely useful, potentially, for improving a portfolio's overall risk-adjusted returns. This is mainly due to their historically uncorrelated nature with traditional stocks and bonds. And interestingly, they often exhibit what's called positive right-tail skewness, or crisis alpha.
Positive right-tail skewness, what's that mean?
It means they tend to have maybe more frequent small losses, but occasionally they capture really large gains, especially during market turmoil when trends become strong. This positive skewness can be really valuable because it helps balance out other strategies that might have negative skewness, like those short put profiles we talked about.
Ah, okay. So global macro is the big picture, top-down, often discretionary strategy, while managed futures are typically systematic, quant-driven, looking for trends across futures markets. Both highly leveraged, but potentially powerful diversifiers. That's a huge distinction.
Absolutely. A very important difference in approach.
Okay, then we get to the specialist category. Sounds niche. You mentioned volatility trading.
Yeah, this is definitely getting into more specialized areas. Volatility trading, or vol-arb, involves actively trading the level of volatility itself or the relative volatility across different assets or geographies. Basically, managers try to identify when volatility looks cheap compared to historical levels or future expectations and buy it, or when it looks expensive and sell it.
So they're not betting on prices directly, but on how much prices are likely to move. That's another layer of abstraction.
Exactly. Taking a long volatility position means you profit if volatility increases. These positions often have positive convexity, meaning they gain disproportionately more when markets make big moves, which makes them potentially useful for hedging portfolios against crashes. Conversely, short volatility strategies aim to collect premiums by betting that volatility will stay low or decrease. They try to extract steadier returns in normal, calmer market environments.
And what role does that play in a portfolio?
Well, it can be a useful source of uncorrelated alpha. And specifically, long volatility strategies can provide risk mitigation for long equity investments. Because volatility often spikes when stock markets fall, they tend to have a negative correlation during downturns. This raises an interesting question for you, thinking about all these different approaches. What stands out to you so far as maybe the most counterintuitive way these funds try to make money?
That's a good question. For me, I think, maybe it's a tie. That equity market neutral idea, trying to completely cancel out market risk just to profit from relative stock movements, that's pretty clever and counterintuitive. But also another niche specialist strategy, our sources mentioned, reinsurance and life settlements. The idea that funds are trading things like catastrophe bonds or buying secondary life insurance policies.
Right, life settlements.
Yeah, where the fund becomes the beneficiary, keeps paying the premiums, and essentially profits if mortality occurs earlier than expected. So definitely not correlated with financial markets, but wow, that's a unique way to generate returns. Very counterintuitive for a typical investor.
Both excellent examples, and they really highlight the sheer breadth of what falls under the hedge fund umbrella. Truly uncorrelated alpha sources.
Definitely. Okay, so lastly, we had that multi-manager category again. Let's dig into the difference between fund of funds, FOF, and multi-strategy funds, MSF.
Right. So, a fund of funds, as we touched on, allocates capital out to a diversified portfolio of separate, independent hedge fund managers. The main appeal is diversification across different managers and strategies, manager selection expertise, and potentially providing access for smaller investors who couldn't meet the minimums of the underlying funds directly. They generally aim for steady, lower volatility returns through this diversification and typically use fairly modest leverage at the FOFF level itself.
Okay, sounds reasonable. What's the catch?
Well, the key potential disadvantage is often that double layer of fees. You pay fees to the FOF manager, and the FOF pays fees to the underlying hedge fund managers. That can be a significant drag on returns.
Fees on fees.
Exactly. And there's also something called netting risk.
Netting risk, that sounds problematic. What is it?
It can be. Imagine the FOF invests in 5 different underlying funds. Let's say 3 of them have a great year and make money, but the other 2 lose money. The FOF might still have to pay performance fees or incentive fees to those 3 winning managers, but the losses from the other 2 funds drag down the overall FOF return that the end investor receives. So you could end up paying performance fees even if your actual investment in the FOF is flat or even down for the year.
Ouch. Okay, that's a definite drawback. So how do multi-strategy funds compare?
Multi-strategy funds, or MSFs, are different because they combine multiple investment strategies under one roof, managed by internal teams within the same firm. This structure allows for potentially faster tactical asset allocation. The central management team can shift capital between strategies more quickly based on market conditions. They also have full transparency into the risks being taken by all the internal teams, which allows for potentially better real-time risk management and understanding of how different positions might interact, especially during stress.
So more centralized control and maybe more agility.
Generally, yes. And because it's all internal, MSFs usually have more investor-friendly fee structures regarding that netting risk. The overall firm typically only earns a performance fee if the entire fund is profitable, netting the gains and losses across all the internal strategies first.
That sounds much better for the investor.
It generally is from a netting perspective. The trade-off is that MSFs generally tend to outperform FUFs over time, according to the sources, but often with a bit more variance in returns and potentially higher overall leverage compared to the average FUF.
Okay, so a FOF gives you broad diversification across external managers, but potentially at a higher cost due to fees and netting risk. An MSF is perhaps more agile, better fee structure potentially, but centralizes the operational risk within that single firm. It's definitely a trade-off, isn't it? It depends on what an investor is looking for.
Precisely. Different structures for different needs.
Right. So with all these wildly different strategies, all the leverage, the niche markets, how do investors even begin to understand the actual risks involved? It sounds incredibly complex just looking at the surface.
Yeah, it really is. And if we connect this back to the bigger picture, this is where things like factor models become absolutely essential. They help understand the intrinsic characteristics and, critically, the risks of these funds, especially given how dynamic their exposures can be. Our sources detail a specific type called a conditional linear factor model. Now, forget the complex math name for a moment.
Please.
Right. The crucial insight here is that this kind of model helps reveal how a fund's exposure to certain risks, like stock market risk, interest rate risk, volatility risk, might become dramatically significant during abnormal market conditions, like a crisis period, even if those exposures seem pretty small or insignificant during normal, calm market times.
Okay, wait. So it's not just about what risks you normally take, but about uncovering hidden risks that suddenly jump out and bite you when markets get really crazy. That feels like a crucial distinction most investors probably don't think about.
Exactly, that's the key. The model essentially has 2 parts baked into it. One part looks at the fund's sensitivity to various factors like the S&P 500, interest rates, currency movements, commodity prices, credit spreads, the VIX volatility index during normal times. But then there's a second part that specifically measures the incremental or additional exposure to those same factors only during crisis periods. It uses what's called a dummy variable that sort of switches on only when markets are stressed.
Okay, so it separates normal risk from crisis risk.
Precisely. And it also isolates alpha, which represents the manager's unique skill or return generation that isn't explained by these common risk factors.
So how does that help in practice?
Well, think about it. During normal times, a fund might want, say, positive exposure to rising stock markets. Makes sense. But during a crisis, when equities are plummeting, the desired exposure would likely be negative. You'd want the fund to be positioned to benefit from, or at least be protected from, falling stocks. Similarly, you might want positive exposure to rising volatility during a crisis, because volatility often spikes when stocks fall, acting like a natural hedge.
Right, that inversion of what you want in good times versus bad times is really telling. It shows that what works in calm markets could actually be really detrimental in a crisis if that exposure doesn't change.
Exactly right. And this type of conditional analysis can reveal potential problems. For instance, the sources mention that analysis might show that some multi-manager funds, despite being diversified, actually exhibit negative exposure to the VIX volatility index during crises.
Negative exposure to volatility when volatility is spiking. That sounds really bad.
It would be highly undesirable, yes. It means a fund might be structured in a way that gets hurt even more when market fear is highest. It highlights why understanding these conditional exposures, not just average exposures, is so incredibly critical for due diligence.
So this shows you, the listener, that sophisticated investors are using these advanced tools to really peek behind the curtain of just reported performance. They're not just looking at the returns, but digging into how those returns are generated and, crucially, under what market conditions those return drivers might change or even reverse.
That's the essence of it, understanding the how and the when.
Okay, so let's bring this all together. What does this complex world mean for someone with a more traditional investment portfolio? Maybe like a classic 60% stocks, 40% bonds mix. Does adding a slice of these hedge funds, even with all their complexities, actually make a tangible difference?
Yeah, that's the million-dollar question, isn't it? And the sources provide some pretty compelling evidence here. They show that allocating even, say, 20% of a portfolio to an equal-weighted basket of different hedge fund strategies, so shifting a 60-40 portfolio to maybe 48% stocks, 32% bonds, and 20% hedge funds almost always decreases the total portfolio's standard deviation.
Standard deviation.
Yeah.
That's a measure of overall risk or volatility, right? So adding hedge funds generally lowered the portfolio's risk.
In most cases studied, yes. And at the same time, it typically increased the Sharpe and Sortino ratios.
Ah, those ratios again. Remind us what they measure.
Sharpe ratio measures your return per unit of total risk, standard deviation. Sortino ratio is similar, but it only considers downside risk, the volatility of negative returns, which some argue is the risk investors care more about. So higher ratios mean better risk-adjusted performance.
Okay, so lower overall risk and better returns per unit of risk. That sounds good. What about big crashes?
That's maybe the most interesting part. The analysis also showed that adding that 20% hedge fund slice often decreased the portfolio's maximum drawdown.
Maximum drawdown, that's the largest drop the portfolio experienced from a peak to a subsequent trough, right? So smaller losses during the worst periods.
Exactly. Incredibly important for preserving capital and, frankly, for an investor's ability to sleep at night during market downturns.
Wow, okay, that sounds like a really powerful combination then. Lower overall risk, better returns per unit of risk taken, and potentially smaller losses during downturns. So hedge funds aren't just for aggressive growth, they can actually add stability.
Precisely. The data suggests they can act as both risk-adjusted return enhancers and as diversifiers, helping to smooth the ride. But, and this is crucial, it's definitely not uniform across all the different strategies we've discussed.
Right. The specific strategy matters. Which ones stood out?
Well, for pure return enhancement in these combined portfolios, U.S. small-cap long-short equity strategies actually generated the highest average return contribution. Fixed income arbitrage, distressed securities strategies, and systematic managed futures also added significantly to returns.
Okay, and what about those risk-adjusted performance measures? The Sharpe and Sortino ratios, who won there?
According to the source's analysis of adding a 20% allocation, the combined portfolio, including systematic managed futures, achieved the highest overall Sharpe ratio. Distressed securities, fixed income arbitrage, global macro, and equity market neutral strategies also resulted in portfolios with strong Sharpe ratios. For Sortino ratios, which focus specifically on that downside risk, strategies like equity market neutral, systematic futures, and LS equity performed particularly well in the combined portfolio context.
Interesting that systematic futures pops up high on both returns and risk-adjusted returns. What about pure risk reduction? Literally making the portfolio less volatile or less prone to those big, scary drops?
Yeah, for reducing standard deviation, strategies like systematic futures again, but also funds of funds that focused on macro or systematic managers and equity market neutral were very effective at lowering the overall portfolio volatility. And when it comes to minimizing that maximum drawdown, experiencing the smallest losses during market stress, the opportunistic strategies like global macro and systematic futures really shone. Merger arbitrage and equity market neutral strategies also generated combined portfolio portfolios with notably smaller maximum drawdowns compared to the 60/40 benchmark. They provided strong risk mitigation benefits.
So those seem to be the champions of risk reduction in a portfolio context.
Yeah.
Were there any strategies that maybe didn't provide as much of that risk reduction benefit or even increased drawdown risk?
Yes, that's an important caveat. Conversely, strategies like LS equity, despite its return enhancement, event-driven focused on distressed securities, and relative value strategies like convertible arbitrage sometimes resulted in combined portfolios that showed relatively high maximum drawdowns. This might be due to the inherent leverage in some, or the binary nature of event-driven bets, or perhaps liquidity issues becoming problematic during market stress, so they offered less benefit purely from a drawdown reduction perspective. It's a key nuance.
And what about the multi-manager funds, FFs versus MSFs in the portfolio?
Right. The analysis suggested that while funds of funds are designed for diversification, adding a 20% allocation to a diversified FF often did not enhance risk-adjusted performance, like Sharpe ratio, as much as adding some of the top individual strategies did. And maybe more concerning, in some FUF categories, adding that 20% allocation could even substantially increase the portfolio's maximum drawdown compared to the traditional 60/40.
Really? Increase the drawdown, even though they're diversified.
Potentially, yes. Perhaps due to the fee drag or maybe the specific mix of underlying managers held by the FEFs studied. The sources did note, however, that multi-strategy funds generally tended to provide better outcomes than FEFs when added to the portfolio.
Okay, this analysis is super important for you, the listener, because it really clarifies things. It shows which specific hedge fund strategies seem to truly offer diversification and risk mitigation benefits when added to a traditional portfolio, versus those that might be more focused on enhancing returns, sometimes even at the potential cost of higher drawdowns during stress. It's definitely not a one-size-fits-all solution, is it?
Not at all. Selection matters immensely.
Wow, okay. We've covered a lot of ground in this deep dive. From the fundamental ways we classify these funds, through the detailed mechanics and goals of specific strategies like LS, EMN, Merger Arb, FIA, Macro, Managed Futures, all the way to the complex world of conditional risk modeling, and finally, their actual impact on a portfolio. It's crystal clear now that hedge fund is far, far from being a monolithic term.
Indeed. We've really seen how the strategies range hugely from precise stock picking, trying to isolate alpha, to betting on specific corporate events, from exploiting tiny fixed income inefficiencies with sometimes huge leverage, to making big picture macro bets or systematically following trends with algorithms. Each one has its own distinct characteristics, its own implementation style, and potentially a very unique role it can play within a broader investment portfolio.
And the data we looked at shows us that, when chosen wisely and understood properly, certain hedge fund strategies can significantly improve a traditional portfolio's risk-adjusted returns. And perhaps just as importantly, they can even help reduce those scary maximum drawdowns in market crises. But as we've really hammered home, the specific strategy and its inherent risks truly, truly matter, especially how those risks might change or amplify during periods of market stress.
Exactly. Understanding that conditional nature of risk exposures, how they behave differently in normal markets versus crisis times, is really paramount for appreciating the true potential contribution or potential danger of these strategies. It's about so much more than just looking at past average returns. It's about understanding the engine under the hood and how it performs under pressure.
So as you, our listener, reflect on this deep dive, what does this more nuanced understanding of all these different hedge fund strategies mean for how you think about risk and return in your own investment landscape? And maybe what kind of unique opportunities or perhaps unique risks might be hiding in plain sight that you hadn't considered before, now that you know just how truly diverse and specialized this world of alternative investing can be?